So, I mean, so cap rate is defined by a lot of people in a lot of different ways. At the end of the day, it is what a cap rate represents is return on capital invested. So if you paid cash for a property, if you paid $1 million for a property and it had a 5% cap rate, that means that the net income on that property should be $50,000 a year. That at the end of the day is what a cap rate is. It's a net operating income divided by the purchase price. So it represents an unlevered return on a performing, stabilized asset. So where cap rates get into trouble, and you should never look at the cap rate in terms of deciding whether or not you're going to make an investment, depending on the asset. Cap rates are a sentiment of value in the market. So certain assets in certain markets, will trade at certain cap rates. Like you're in Philadelphia. So if you're looking at Class A multifamily properties in Philadelphia of 200 to 400 units, they're probably going to trade at a 4.5 to 5 cap, somewhere around there. If you move into the city proper and you're looking at Class A, high rises, they might trade at a 3 cap. If you move out to the suburbs and you're looking at garden style, older Class C, B, C product, it might trade at a 5 or 6 cap, depending on the market. So it's kind of a means of conveying the value from a sentiment in terms of the marketplace. It's what appraisers use to value properties. It's what investors use to make decisions. But cap rates are only as good as the income on the property in terms of looking at it from an actual basis. Because again, if a building is vacant and it's not producing any income, you can't really put a cap rate on that because there's no income. Cap rate is an income-based calculation that can be relative to, all kinds of things, the condition of the property, the income that's coming in, those types of things. But at the end of the day, commercial properties trade on a multiple of the income that it's generating, net operating income, meaning you take all of your expenses, you have your income, you subtract all your expenses before debt service and divide that by the purchase price, and that gives you a cap rate. Or you can do, the income divided by the cap rate, and that will give you a value of the asset in a market. If you know the cap rate, but you don't know the value, you just take the income divided by the cap rate, and that gives you the value. So that's really all it is. And it's really funny. It's a very confusing thing across the market, but unless you're looking at a stabilized asset, which is what you would call a core asset, that there's very little value add, it's just a stabilized bond kind of a play, you're looking for an income play, then you can look at cap rates. So if you say, hey, I want to earn 5% of my money, then you can look at cap rates, and that's what that represents if you were paying cash. If you're levering the asset, in other words, if you're borrowing money, your cash on cash is based on your down payment. So, at the end of the day, it boils down to what kind of return are you looking for on your cash that you have to invest? What is your upside in the property, and what is your long-term strategy? And what are you willing to do? Do you want something you have to put a lot of effort and money and time and energy into, or do you want something that's stabilized? You don't have to do anything and it just generates consistent income. So that's kind of how that works.